Hello, I would like to start off by introducing you all to my co-managers Michelle McKay, Randy Rollins, and myself, Christine Saji. We are in Industry 3 and our company is Alpha Athletics. We pride ourselves in the company and what it stands for. Our strategic vision is to always be first by providing superior shoes to consumers and a positive active return to our shareholders. We're keen to seek out opportunities in today's global market, and this allows us to remain one stride ahead of our competitors while maintaining a positive return. We value our customers and their desire for affordable and durable shoes. We continue to invest in our cutting-edge design and innovative footwear apparel. Alpha Athletics is on its way to be a household name in the footwear industry, delivering consistency in performance delivery not just for our consumers, but also for our shareholders. Alpha Athletics, we simply don't do last. Competitive strategy in branded footwear. Our company likes to produce high-quality athletic footwear at competitive prices. Our smaller and customized product line helps control costs for our end users. We focus on maintaining plants in North America and Asia Pacific. In terms of pricing, our internet prices are 40% higher than wholesale price. We always strive to increase our SKU rating. In regards to our competitive strategy in private label, we have global best cost and a multi-regional strategy. We pride in being a low-cost provider of high SKU-rated athletic shoes according to the market we are in. Alpha Athletics utilizes private label sales to spread fixed costs and thereby lower per unit cost for our end users. Initially, our company had increased global production with the goal to leverage profit margins. But as our company grew, we had a focused strategy year over year to combat competitors from attempting Alpha strategy. Year 14 is when competition strengthened in the private market, and as profit margins in the private label decreased in the latter years, Alpha Athletics decreased its participation accordingly. After year 15, participation in private label was non-existent in all regions except for Asia Pacific. This slide provides an overview of the annual total revenue for Alpha Athletics. When you look through the growth, we can see that there was a consistent growth throughout the years. Between year 10 and year 17, the company had an average growth rate of 7.37%. Year 16 was the best year, with the net revenue at $407 million. Increased competitive pressures in the wholesale and private distribution channels caused our revenue to decrease by 9.61% in year 14. However, we were able to adapt to the market and alter our strategy. We were able to come back up in year 15 with a 16.3% increase in growth. Now, I'll pass it to Michelle McKay to talk through the next slide.
Earnings per share is a gauge as to how profitable our company is per share of stock. In this case, you can see that in years 11, 12, and 13, we did exceed our investors' expectations by as much as $3.45. But you'll also note that in year 14, we struggled quite a bit, and in that 1 year only, we did fall short of the investor expectations. But it's worth noting that in year 15, we managed to turn that around, get back to the plus side of our investor expectation, and we increased our growth rate quite a bit. Global market share was not one of our strongest points, but that has a lot to do with our strategy, which was to focus on higher SQ, higher quality shoes, and a smaller line of shoes, which as such explains why our market share wasn't huge. Regardless of this fact, we were still able to be profitable and have a good amount of revenue. Year-end stock price is the value of the stock at the last trading day of the calendar or fiscal year. And in every year, we were able to exceed our investor expectations. However, our growth rate in year 14 did fall onto the negative side, but it's worth noting that in year 15 we were able to turn that around back onto the plus side and exceed our investor expectations quite a bit. When it came time for our 3-year plan, this occurred right after our year 14 and when we really struggled. So we went into the 3-year plan with the attitude of being conservative. We certainly wanted to meet our investors' expectations. We didn't want to do anything too crazy in an effort to get back into the game and get on the plus side again. And with our 3-year plan, we were able to meet or beat investor expectations in all 5 sections of the 3-year plan. We were able to also increase our revenue in what we perceived to be an increasingly competitive marketplace. We noted that after year 13, our competitors became a lot more aware of how the game worked and were able to study what we were doing and cut into our profits a little bit. So we definitely wanted to make sure that we could turn that around. And as a result, we were able to increase our revenues in years 15 and 16. We did have a slight decrease in year 17, but we still managed to win in our industry.
Throughout the competition, we considered our primary competitor to be Team C. We also considered teams E and I to be competitors, but no team did more to disrupt and alter our strategy than the actions of Team C did. Viewing the history of the wholesale distribution channel, which was the largest distribution channel, we can see how the competition with Team C affected our initial overall strategy. When first looking at the strategic maps for the 4 regions from year 11, you would think that Team E would be our largest competitor, due to Team E's proximity to Alpha Athletics, which is Team A. We were very pleased with our strategy coming out of year 11. We had a low model count and high SQ-rated footwear, and we had decent separation from most of the rest of the companies who were competing for market space in the center of the strategic maps. We had hoped our separation from the other companies would continue. However, in year 12, Team C joined us in our market space. As you can see in the strategic maps, Team C is now situated almost right on top of Alpha Athletics in all regions. Our revenue had an increase of 9.7% on the year due to slight increases in our prices per pair in each of the 4 regions. However, our units sold dropped by 65,000, and we feel this drop was directly attributable to this newfound competition. In year 13, with Team C increasing their model count in all regions and their S&Q rating to a 9 in the North American region, we managed to get much of the separation we enjoyed in year 11 back. With this newfound market separation, our revenue increased 11% on the year. However, our units sold dropped by 426,000, which we feel was due in large part to the competition still from Team C and from many of the other companies that seem to be drifting toward our market space, especially in the Europe, Africa, and Asia Pacific regions. This competition helped create a larger overstock condition in our warehouses than we anticipated, and handling this overstock coupled with Team C rejoining us again in our market space caused our revenue to decrease for the first time by 7% in year 14. At this point, due mainly to the efforts of Team C, the co-managers of Alpha Athletics decided that we could no longer continue with our current strategy of being the lowest cost provider of 8 S&Q rated shoes and needed to alter that strategy. The decision was made to move into the open market area of 6 S&Q rated shoes in the Europe, Africa, and Asia Pacific markets, and maintain the 8 S&Q rated shoes in North America and Latin America in the hopes that Team C would vacate that market as they did in the past. In year 15, this decision proved to be successful for us as revenue increased by 16.3% and pairs sold increased by over 2 million pairs. However, Team C as well as Team E had continued their competition for the same market space in the North American and Latin American regions. Because of this competition, the co-management of Alpha Athletics decided to produce the highest quality product we could produce in the hopes of raising margins and gaining complete control over the market for 10 S&Q rated shoes. This strategy worked in year 16 as revenues reached their highest point of $407 million, which was an increase of 5% over the previous year, and we had again achieved the separation from Team C that we were trying to attain. Year 17 saw Alpha Athletics following the same strategy as the previous year. This year saw revenue decrease due in large part to lowering of prices by many of the companies in Industry 3. Team also was successful in attempting to take some of our company's market share. Viewing a comparison of Alpha Athletics and Team C's North American wholesale prices and S&Q ratings, we can see how close the competition was between these two companies. Starting in year 12 and continuing through year 17, both companies produced shoes of an 8 S&Q rating or higher in this region. The two companies' internet prices were comparable in years 14 and 17, with only one huge variation in year 16. Wholesale prices were also very similar, with Team C starting to set prices under Alpha Athletics considerably only in years 16 and 17. Viewing a comparison of Alpha Athletics and Team C's North American market share, we can also see the similarities between the two companies, including both companies falling out of the private market in years 16 and 17. In conclusion, Team C was a worthy competitor who was successful in affecting the strategy of Alpha Athletics. However, ultimately, they were not able to find a strategy to differentiate themselves in the market space that they shared with Alpha Athletics, and only once in the three performance measures of earnings per share, return on equity, and stock price did Team C manage to best Alpha Athletics, which was in return on equity in year 14. Team C's highest weekly ranking was 4th, and their final ranking was 5th overall. And now here's Michelle to talk about lessons learned.
A few of the lessons that we learned is that it's important to not depend only on high margins in the private label market after year 13, which explains some of the issues we ran into during our down year 14. We needed to have an aggressive strategy to participate in the internet market, and we realized not investing in plant upgrades too early on was beneficial so that we could better understand the competitiveness of the markets we wanted to play in. In hindsight, we should have probably purchased the maximum amount of stock every year, which would have helped our ROE. We realized it's important to not hesitate to take out loans to finance projects as long as you can pay them back. And we realized it was not necessary to overspend on celebrities, and we were able to procure some good contracts at lower levels. And we feel that while corporate citizenship is worthy and admirable, it wasn't necessary to achieve our profits and cultivate a good corporate image. And most importantly, we felt understanding our competitors by analyzing the decisions that they were making helped us to better anticipate what we should be doing in order to win.